Hi, everyone. It's John Pocoroba. Welcome to my general market update. It's March 27th, 2022. Just a reminder, this presentation is made by Rain King LLC for educational purposes, and I am an amateur individual growth stock investor, and I'm not affiliated with MarketSmith or IBD, though you may see MarketSmith charts throughout the presentation. Okay, the agenda today is going to be brief update on the big picture. Then we're going to talk about the news. Then we're going to talk about an update on follow through day number 2 and our 2011 precedent, and crowd psychology and your average cost, and a potential pullback and what to look for. But before we dive in, I just wanted to wish Bill O'Neill a happy birthday. I believe he is 89 years young today. And I just want to say a thank you to Bill for sharing and teaching all us investors how to be successful in the market. Thank you many times, Bill. Okay, let's get into the big picture and go to work. I've shared this chart before. It's a monthly chart of the Nasdaq composite. The whole premise of this chart was some very long-term support areas in the Nasdaq, and the premise was we could come all the way back down to the 11,000 level in the Nasdaq and still be in the bull market super cycle. So let's look a little closer at this. This is the Nasdaq on a weekly chart as of Friday. We came down to the 12,555 level at the lows of the Nasdaq correction, and we've had 2 weeks now of blue weeks. You can see we had our biggest blue week in over a year last week, and then this week was another constructive week of gains. I've just drawn this line here at roughly the 11,000 level to give you some perspective about we could come all the way down to this level and still be into some long-term support, maintaining the super bull cycle thesis. Though we all might want to see the market, do what this green line is showing, we have to be prepared that it's possible that this just might be a bear market rally. And if this is a bear market, counter trend rallies can last for weeks and or months. And so you can get really faked out if you're not staying on your toes. And if you don't believe me that counter trend rallies can run for a while, this chart to the right is the Nasdaq, a weekly chart from 2008. I've shown in this first circle, this was an 18% rally in the Nasdaq right up to the 200-day moving average in 12 weeks, and then it rolled over. And then following that, we had a 5-week rally in the Nasdaq, which ran 14%, that got to the 200-day, and we rolled over hard into the second leg down of a pretty deep bear market. So counter trend rallies, we have to be aware that those are possible, even though right now we're in a rally attempt. So news. I want to talk a little bit about the news. And I want to talk about the news, not by actually quoting what's going on with the headlines, but I want to talk about it more as it relates to investing in the market. Be aware that, most news is negative. TV, print, the web, all of these outlets for news, their goal is to sell ads, and they want to attract eyeballs. That's all they're interested in. So they sensationalize the news in order to attract people by their headlines, their stories, their propaganda. Never forget that they're just trying to attract eyeballs. They're not really trying to give you news that you can use to trust in your investment decisions. You cannot trust the news. Frequently, news is going to be confusing headlines and inaccurate information. Right now we hear daily inflation worries, inverting yield curves, Fed rate hikes, economic slowdowns. There's always something in the news which is negative or something to worry about. If it's not inflation, it used to be terrorism, trade wars, debt ceiling crisis, pandemics, hedge funds blowing up, on and on and on. The news is always the worst around market bottoms. So forget the news, turn off CNBC or whatever channel you're listening to. You don't need it to be a successful investor. And I use a fighter pilot analogy. If you were in a wartime air fight and it's nighttime, there's heavy clouds and a rainstorm, and you're trying to navigate in a wartime situation, how do you do it? Well, you can get very, very confused. The headlines and news are changing, and you're trying to operate a plane. So how do you operate your plane? Well, you have to trust your instruments, and your instruments will help you guide you through the clouds and the rainstorm and the situation. So the analogy is, we do have instruments, our guides in the market, and they're unbiased. Right now we had our second follow-through day. Follow-through days, if you follow the canceling approach, you need to be buying something, gradually increasing your exposure. Breakouts, if they're working and following through, you're probably increasing your exposure. We want to look at our instruments in terms of the breadth of the market. What are new lows doing? What are the big institutional names? What is their action telling us? And if we get our first meaningful pullback, we want to be able to analyze it and look for clues. These are our instruments in the market. So the point of this is to follow your instruments, even though the news is confusing and clouding and negative. Don't get thrown off by the news. Follow your instruments, follow your rules, and they will guide you to make good investment decisions. So let's switch over to look at the 2011 precedent and follow through day number 2. So I have the Nasdaq daily chart on the left, and I have the Nasdaq 2011 bottom shown on the right. I used this last week, and I wanted to just simply do an update. Last week we were right about here. We had the follow-through day. We had a constructive week. We've gotten above the 50-day, which is all constructive. There's going to be a pullback somewhere along the way. If we get a pullback, the importance of the pullback is we really, really want to cement in place a higher low. Once you've broken the initial downtrend line and we've gotten above the 50-day, we want to get a higher low to show that the trend is changing and potentially changing to be an uptrend. So looking to the right on the Nasdaq, which I've been using as a guide in terms of what could happen. Last week we were right about here on this 2011, and now we've gotten kind of in this zone right here because we were above the 50-day. This is the 2011 precedent, above the 50-day, but we're still below the 200-day. And you'll notice that the market did pull back and chopped around for almost 4 or 5 weeks before it tried to make a run above the 200-day. And eventually, this is important to note, look at this powerful, scary shakeout which occurred. Broke the 50-day, things looked really, really bad, but they also reversed course very quickly and came back up. So, we don't know what the market's going to do. We don't know if we're going to have a shakeout. We don't know if we're just going to go zooming to new highs. But if I were to say, where are we relative to our market? We're in this red box, sandwiched between the 50 and the 200. That's where we are. And again, we have to also be aware that possible this is a bear market counter trend rally, which could completely roll over. So we have controls in place, risk management to watch ourselves. So some institutional names, which I think are really important to watch for clues as this rally develops. The first chart that I think is really important is Tesla. Tesla is an institutional favorite. And the reason being, it's a very large company with very high earnings and sales, which is a very, very rare combination. The importance is Tesla had a very, very strong week last week, and it got it right up above the 1,000 level, which is a psychological level. And it actually equates to approximately the 1 trillion valuation for Tesla. So I think this is a very important sign to see if Tesla can hold this 1,000 level and move higher. That would give us an indication that institutional investors are coming back into the market for some of the strongest growth names. The second chart, which I think is very important, is Apple. Apple has had a great 2 weeks coming straight off this double bottom, but the level that I think is really important in Apple is 180, which happens to be very close to the left side high in this double bottom pattern. 180 represents a 3 trillion valuation for Apple. So I'd keep our eyes on that to see if we're going to get rejected or if we're going to move higher. Again, we're trying to understand if institutions are going to bid these companies higher or if they're sellers. And the third one I'd keep my eye on is NVIDIA. NVIDIA also had a very good 2 weeks coming up on the right side of the base that it's trying to form. It's gotten back above the 50-day, and it's also above the 20-day moving average. The key level in NVIDIA is right around the 300 level. And the reason I think that's important is this day way back in the fall, in November, it's the highest volume on the chart. Over 115 million shares were traded that day. And it's going to be interesting to see if NVIDIA runs into that as a stone wall and peels off, or it gets bid above that because institutional investors think the stock should have a higher valuation. These are 3 key stocks that I'd be watching as this rally continues to develop. So let's talk a little bit about where we are relative to the second follow-through day. I mentioned a week ago about some of the data that I keep. The gains from the second follow-through day could be 9.8% on average over the next 3 months. And they typically, the second follow-through day would not be undercut. And if that happens, it averages about 90 days to get back to new highs. So where are we? Well, since the follow-through day last week, we were plus 2% since the follow-through in 7 calendar days. To give some perspective, if we use history and said, well, what does the 9.8% represent? That would be a Nasdaq number of 15,261, which is within almost 5.8% striking distance of new highs. That'd be really encouraging if that played out. That's a possibility. We also have to be prepared that possibly follow-through day number 2 fails. And if the second follow-through day does fail, a deeper, longer bear market is probably already underway that initially started back in November of 2021. So we take it day by day. Right now, the market's still rallying, and things are starting to look constructive on some of the charts. So psychology and average cost is our next topic. So I tweeted out this chart, which was crowd psychology in a bull market, and I've used this before in different meetups. But the part of the chart I really wanted to focus on is the very beginning. And I had tweeted out that if you're taking a stab at this follow-through day, strong first buys are very important. Don't be too timid, but you still must manage your risk. In case you're wrong and the rally fails, you need to get out. Now, when you've been beat up and we're at market bottoms and you've been beat up and you've had some losing trades and we've come off so much and the news is terrible, when things start to move on a follow-through day, people get very, very timid. And they don't buy properly. They buy small positions on a breakout, and then they wait. And then when they become sure that the rally might take hold, then they add to their positions, and then a normal pullback might scare them out of their position. They sell. If they get through the first pullback, they say, I'm glad I got back to even, but they sell very quickly. That's a very timid frame of mind early in a bull market. So I wanted to go deeper into the concept of psychology and watching your average cost, which I tweeted out is so very important when you're starting out your positions. So I used this chart over the last 3 videos. I wanted everybody to be aware. Be aware if you're going to play a stock that's in a 50% correction, and we had talked about the stock that comes off that high needs a new prior uptrend and probably has another small base somewhere within the bigger base. And you have to be prepared for that kind of action as you position your size. The second one is stocks that only corrected 20 to 30%, which are stronger situations, but we still want to watch our average costs in those situations. So I want to go through a couple of examples about what I mean by watching your costs very, very closely and being aware if you're in a situation with a small 20 to 30% pullback, or if you're in a situation that you're trying to play a stock that's at a 50, 60% drawdown. So let's look at the deep correction that many growth stocks have had. Now, this whole idea of average cost is you need to plan ahead. You need to start to anticipate, how you're going to add to your position. And you want to do this planning when the market's still closed, because it's all about anticipating scenarios about what could happen and how am I going to play this out. And I've already thought through your strategy. So in this case, stock falls from 100 to 50. Then it has an uptrend and it gets up to 65. You're still way off the highs, but the stock forms a base. So in this example, let's just say that you found an early entry and you bought a 5% size position and you make your first buy at $55 per share. Things start to work and you get kind of excited and you say, geez, this is starting to work. I got my hands on a winner. And so when the stock reaches $65 a share, you decide to buy another 5% size. So now you have a 10% position size, but your average cost is 60. So you can see if your average cost is 60, as I've shown on this diagram, if the stock gets to 65 and it's going to have its first correction and base. Now I've drawn a 15% deep base. A 15% base is not that deep, but you can see that drops the stock all the way back down into the $55 range. And you can see that, this formation of a base within a larger base is normal when you have stocks that have corrected 50, 60, 70%. So be aware of this potential as you're trying to consider where you're going to make your next buy. Because if you add too aggressively, you could be in this situation where you've actually have an average cost that is really, really vulnerable. In this particular example I showed you, if you had held, your first position here basically is at break even, but this position here, if you held through this base, you're down 15%. So the whole position is messed up. It's all messed up because the average cost has been driven too high. You added too soon to the position. So it's something I wanted to make people a little more aware that, this is a likely scenario you have to be prepared for in advance when you're trying to decide if you're going to make a second purchase. So let's look at a similar example, but with a stock that's only in a 20 to 30% base. And let's assume in this example, a stock moves up off the bottom and you make a really great purchase. You use a downtrending line off the handle, and you actually make your first buy at $88 per share. Now, the problem with this is you're a little nervous about the market. You really don't believe in this follow-through day. So you only size your position to be 2.5% size position. So the rally starts to take hold. And as the rally really starts to work, now you believe that this rally is going to work. So the stock has run up to about 110. You say, geez, I got to get my 10% position. So therefore, I'm going to make a 7.5% size additional buy. Now you'll notice that, we don't like to buy cup with handles more than 5% above the buy zone from the pivot. Some people would use the pivot as the left side high. Some people will use the pivot as the actual handle high or the downtrend line. Regardless of that, you make a purchase up here, and you can see your average cost from these two purchases is $104 per share, and you have your 10% size. The problem is stock comes back in, and we know from studying CanSlim that 40% of breakouts will pull back and return to the pivot, which is completely normal action. It's almost to be expected. So by driving your average cost in this situation up to 104, you can see that you are under pressure and you're actually at a loss by the time the stock does something which is very, very normal. That's really important to understand. This is normal action. The problem is we're not positioned properly in the stock with a too high of an average cost. So you're probably stopped out here with a 4% loss on the position. And again, after you're stopped out, if this happens, it hurts because you got shaken out on a normal pullback because you weren't properly positioned in the stock. So I wanted to go a little deeper on that because it's so important to get properly aligned and anticipate what could happen next. So pullback, an evaluation of the pullback. Is this a tradable rally, or are we in a new bull market? Well, we take it day by day. We had 4 very powerful days off the lows. Last week was a constructive week. We are now above the 50-day moving average, which is positive. We're still below the 200-day, so we still have some overhead to get through. As I mentioned last time, we're going to learn a lot more from the first meaningful pullback after a rally attempt. You know, do things roll over quickly? Well, so far, so good. This rally is so far, we've had very constructive action. And I've seen some people on Twitter say, well, the market's oversold, the market's oversold. You know, coming off a bear market or a deep correction, a market that is oversold early in a move is actually a really good thing. It could stay oversold for quite a while and actually could be bullish. Now, are we going to digest this rally thrust, you know, in between the 2 moving averages, the 50 and the 200? That's a possibility. I mentioned the 2011 case that spent 4 to 5 weeks sandwiched between those two, and then there was a nasty shakeout. So it's just something to keep aware of. But what are we looking for in this pullback? Constructively, we would look for change. And what I mean by that is, you know, we come back and we hold the 20-day, we hold the 50-day on the pullback. And it would be really positive if the volatility tightened up. We get much tighter price spreads, would be constructive on the pullback because we've had wild weeks over the past 2 months. Watch breakouts. Do they follow through or fail? We are starting to see some of the breakouts stick, which is really something we haven't seen in months. Semiconductors having some good breakouts, as well as some of the other fertilizer stocks, metals, etc. So that's constructive so far. Watching the new lows, I do this all the time. I don't want to see the new lows expanding. In the past week, they're starting to dry up, which is actually, when I say dry up, I mean we're below 100 new lows in a day, which is much, much better than where we were with 600 or 700 new lows only a few weeks ago. So they're drying. Excellent. Now, the institutional names, that's a new piece of information I've shared with you, which I believe are 3 important charts with key levels, which will give us an indication of what the institutions are doing, if they're putting money back to work or if they're going to be selling into the strength on this bounce. So I'd keep our eye on those 3. So you should have some exposure to the market, and you can gradually, you know, should be increasing your exposure only if your initial buys are working and you are watching your average costs. We covered some examples. You want to be patient. If this rally is going to really work, there's going to be opportunities to get in a variety of ways. So be very careful not to run up your average costs, because you will get shaken out on probably a normal pullback. In fact, if we do get a constructive pullback, it might be the opportunity to get in some of the names that maybe you missed. You know, maybe you missed Rambus or Tesla or some of these other names. There's lots of them. So a pullback could be an opportunity. And avoid FOMO. Don't be buying, chasing stocks higher. That's usually a bad system. So with that, that's all the time I have for this week. Again, please join me on Twitter or my YouTube channel, ring the bell, and you can actually get notifications for the next general market update. Thanks, everyone. Look forward to any comments, feedback that you have, and I'll see you soon.